Hello, how are you today, Brett? You doing good?
I'm doing great. Thanks, Cindy.
Awesome. I'm so excited to have you on this call today. Brett is one of our lending partners here at City Kelly and Associates. We have worked with Brett before, and he's super responsive. He's on it, and he really knows his stuff. So today, I thought we would just ask him some questions about lending and what's happening right now in today's environment. Because I mean, right now, real estate is so focused on the interest rates, and there's all these questions, and I certainly don't have all the answers. And so I rely on my partners, such as you, to help guide me so I can guide my clients to a successful solution. So let's dive right in.
Awesome.
My first question, Brett, is what are the factors that influence mortgage rate interest rates, and how can buyers forecast and the rate they might receive for a loan and kind of make plans? Like, what's your thought on that? How's that work?
Yeah, it's a great question, Cindy. So a couple things. I mean, there's some that are going to be more the clients themselves, right? And a little bit of that might be based on their credit score, how much down payment they're doing, what type of loan. But I think a big piece right now is that external factor. Hey, what's happening in the market itself, right? So I think for a lot of folks, there's been a huge focus, and this is media driven around what's the Fed doing or what are the Fed rates. So I always like to help clarify is the Feds do not control mortgage rates. The rates specifically the Feds control are the discount rate, or the Fed's funds rate. But those are the rates that the banks borrow from each other or banks borrow from the Fed. So not necessarily mortgage rates. Now, that being said, the Fed has a massive influence on the market, of course, right? To say, hey, what's going on? Hey, if the Fed's raising rates, there's probably a reason economically, which may drive interest rates to go up for mortgages too. So the good news is, at this point, very widely expected the Feds are for sure done raising their rates. Or focusing on, there's some argument amongst the investors, are the Fed's going to lower rates on their end in March or later in the year. But the idea that they're coming down is one big influence to the marketplace. Now, one other big one, and this again ties in economically, is just what's happening with the economy. As inflation comes down, that's huge. And why that helps mortgage rates is mortgage rates ultimately are on a market very much like the stock market. I think there's sometimes a mindset out there that a bank sets a specific rate. And very occasionally you might have a unique bank product that is the case. But most mortgages out there ultimately are traded as mortgage-backed securities, just like a stock. Well, stocks can be, go up and down based on various factors, but a lot of that is kind of on appetite. So for example, when we see in the marketplace, when there's a little bit more nervousness around economic factors, hey, the rates might come down, the economy might be a little bit tighter here. That's going to drive investors to move from stocks to bonds or stocks to mortgage-backed securities. So again, that flow back and forth of investor appetite can also really change things like supply and demand would for a house to move rates up or down. So on a very simple note for us, if we see the economy slowing down, inflation's coming down, all those factors help to drive interest rates lower as well for us. So those are some of the external factors, but on a big level, this year should be significantly different in a good way
In a
than the
good
prior
way.
year has been.
Yeah. Yeah. It's been a little rough for buyers out there. So cool. All right. So how does the 10-year treasury note yield impact mortgage rates? And so what you just talked about, how does that affect the treasury note
For
yield?
sure. Yeah. So basically, as I kind of mentioned, there are a lot of times you'll see investors voling between stocks or equity markets and then maybe bond market or mortgage-backed securities. So the 10-year note essentially is a great indicator of what the market's doing, because again, as we have the stock market on one side, we have mortgage rates, and mortgage-backed securities are harder to kind of look up per se, like a stock price, you simply just put in the ticker, you see the symbol. Well, that's where the 10-year note helps out because that's in that similar category of a bond, or a US Treasury note. So those fall in a similar category for investors as mortgage-backed securities do. So for example, so many folks in our industry look, if the 10-year Treasury note is down,
Mhm.
that correlates very, very closely with mortgage rates and vice versa. So again, as we look at it, like rates kind of peaked at the top around October 18th of last year. And the 10-year note was ticking right around 5% or, 4.99. Well, even by, December, the pretty significant drive down, the 10-year note got below 4%, like in the 3.8 range. And it's up a tiny bit this year, but that was a big factor, that showed a correlation with interest rates coming down too. So I wouldn't necessarily say the 10-year note directly controls rates, but it's a very good correlation for us to be able to see, hey, as that drives down, rates are in correlation with it. Vice versa, as that goes up, rates are correlating upwards as well for us.
So that would be a leading indicator, basically, is what you,
Absolutely. Yeah.
yeah.
So like, honestly, every day I jump in and look at, different things in the market, but the first thing, hey, what's the 10-year note doing today? It's a great kind of quick indicator of what's the mortgage market's doing as well.
Okay, that's good to know. I didn't quite understand that myself, so I love that. Thank you. Okay, so then how does a buyer's credit score impact the interest rate that they qualify for, and what can they do to improve their credit worthiness? So there's a lot of people want to buy a home, but there's all these questions. I'm like, well, what do I need to do? I have a bad interest rate. I can't buy a house. I mean, that's honestly, I get that a lot. I have a
Yeah.
bad rate. I can't afford to buy.
Absolutely. So I think there's a couple of things there. So really, and there's different mortgages out there. Of course, we have conventional mortgages, government-backed loans, but let's start with conventional. And that's kind of that just standard loan out there for most Americans.
Mhm.
It works. I think one way I like to explain a lot of times, loans are priced, meaning what the rate would be, very similar to insurance. So for example, if a client calls and says, hey, Brett, what's the rate today? It's very hard to give them a number. Now we can
Yeah.
be general, but honestly, it's pretty much like calling an insurance company and saying, hey, what would be my car insurance rate? Well, they're going to want to know, hey, what kind of car do you drive? Have you had any tickets? How old are you? And that's similar idea. And what we call it is risk-based pricing. And that's as an industry level. So again, as we get into credit score, they're going to say, well, potentially a lower credit score may be deemed higher risk and have a little bit of an adjustment in rate. So essentially, any lender out there for a conventional mortgage will look at those factors overall. Now, so one thing is if credit score is lower, typically there'd be a little adjustment for higher rate. But alternatively, as we have a lot more down payment, that adjustment's way smaller. Because let's say, even though a client might have a little lower rate, if they're putting down 30 or 40%, that's mitigating a lot of risk or lowering the other side. So
Right.
I'd like to encourage clients, guys, just because potentially we have a low down payment or because we have a lower credit score or other factors, there may be other ones that offset those for you. So
Mhm.
like, for example, I've helped a client with a very low credit score, but they were doing 50% down. The rate was still stellar. So it's kind of a combination of things.
Mhm.
Now, in an effort to help fix it, one thing we like to do is just do kind of a review and coach these clients through it. So, but in general, some of the things that can help credit is looking at, of course, late payments is a big hit for credit. So you're trying
Big.
to avoid any
Don't
kind of
ever be
late.
late on your mortgage because that's one
Yeah,
thing that's the first red flag.
absolutely right. And it's tough. I mean, I appreciate why there's an adjustment, but I think it might be a little bit unfair in some sense of how significant it is. Now,
Mhm.
if you've had a late, it's not the end of the world. Every month that goes by, things get better for you. So it will rebuild. But the first biggest thing is try to avoid any kind of lates. Now, the second piece is on any kind of revolving debt, mainly credit cards is the most thing we see revolving. A goofy thing on that is it looks at how much are you using of the limit. So for example, you have a credit card and it has $1,000 limit and you have 900. You're within your limit. It's perfectly fine. Unfortunately, the way the system looks at that is, hey, you're using 90% of your available credit and it dings us for it. I don't personally agree with it because I feel, hey, if we're approved for 1,000, why should I be penalized if I use it? But it's reality. So one
Which
suggestion,
doesn't, so it goes both ways though, right? So if you have your credit maxed out on your card, they're dinging you. But if you have, and they're actually making more money too, which is
sure.
really not fair, right? So
Yeah,
then if it's conversely, if it's low and you have all this open credit,
yeah.
not a good thing either.
Well, I think that the open can be okay. The key is having activity. So to your point, it's goofy, right? Hey, on one hand, if I'm using my credit card, it's close to the limit, I'm getting dinged. But on the flip side, hey, I'm just not going to use any credit cards. I cut them up, throw them away. Well, now there's not that activity.
That's not
So
good either.
my suggestion is it's based on that percentage. So as weird as it sounds, if it was 90% and you paid a couple $100, now that's 70%, a big difference. Now you pay a couple $100 more, it's 50%. Now, as weird as this sounds, let's say we had $1,000 worth of credit card debt. Well, if it's on one credit card with a limit of 1,000, we're 100%. Well, if it was split on two credit cards, but each of them had a limit of 1,000 and they were both at 500 balance, you still owe $1,000. They're both at 50% though. So I don't necessarily want to encourage going and opening a bunch of new cards, but I think it's interesting to see, hey guys, let's keep an eye on what is our percentage of usage. I think if we can keep it as low as possible, it's great. And like, for example, if someone's paid their cards off, I always say, guys, you don't have to ever pay interest, but buy a tank of gas or buy a dinner, charge a little bit on that card so there's activity. And the beauty of that is, hey, every month there's activity, you're paying it on time, and the percentage of usage is extremely low. So that can be a really cool way to build it. But again, on the flip side, I've seen some folks just early in their, credit building career get 3 or 4 little credit cards of $200, $300, but unfortunately, they're all maxed out. So even though it's a very small dollar figure, it might only be $500, $600 total. It's 3 cards at 100% limit. So it's a weird piece
A
there, but if we
weird
figure it
system.
out, very easy to use in our advantage, just keep that percentage low. So those are 2 quick tips to really help boost the score up for us.
That's great. That's really good to know. I could ask more questions. We need to move on. Okay. This is really important. Like when I talk to buyers too, I'm like, okay, I need your pre-approval letter. And they're like, okay, I got it. I'm good to go.
Yep.
Great. Did it go through underwriting? Have you submitted all your docs? Well, what does that mean? He said I could spend $1.2 million. This is what I can afford.
Yep.
Okay, so tell me more. And I've kind of gotten to the point now where I ask, and when I counsel my buyers, I have this like running joke, and I'm like, look, they're basically buying the house for you. You're putting a small down payment, but the bank, like it gets frustrating and it's hard to go through when they ask you all these questions. I said it's kind of like they want to know the color of your underwear. It's really
Yeah.
personal, but
Sure.
you got to understand, like they're loaning you a lot of money, and they want to make sure you're going to be able to pay them back, basically.
Yeah.
So the difference between a pre-approval and a fully underwritten pre-approval. I mean,
Yeah.
we used to say pre-qual and pre-approval, but I think there's
Yeah.
a misnomer there. What I like to say is it underwritten? Have you submitted
Yeah.
your documents? Are you fully approved?
Totally. And Cindy, you're absolutely right. I think that's a challenge for a lot of buyers is because a pre-approval can mean a lot of different things based on the lender. You can go on abc.com, type in 3 things. Hey, here's your pre-approval. Well, that's very, very, very basic, right? And it's relying on what the client input. And it doesn't mean they're intentionally inputting something incorrect, but who
Correct.
knows? But to your point, there's kind of 3 levels I look at is, hey, I literally went online, typed in a few things. That second level is, hey, I submitted an application and someone pulled my credit. Well, the third one is, hey, I've actually sent in documents and they've been reviewed by the underwriter. So ultimately, for the folks listening now, is the underwriter is the ultimate person that approves a mortgage. Traditionally, in the lending industry, they're not involved in a file until very close to the end, after you've made an offer and gone through. And I think that's one of the fundamental challenges of the industry is why are so many loans rocky? Well, you get quote pre-approved, then you make an offer, you're accepted. Now you're getting the real loan, and all of a sudden, this official underwriter comes into the transaction, is asking all these questions or for
It's
more
so
evidence.
stressful. It is so stressful for the buyers. I have to say, I've been selling real estate for 21 years. And that is one of the hardest parts of the transaction is
Yeah,
when they have not prepared up front and they know. And the craziest thing, those underwriters ask questions oftentimes that their lender, not you, I'm not talking about you, their lender
sure,
hasn't asked, right?
for
So then
sure.
we run into these challenges right at the end. And for me, I'm like, no, I want that pre-approval underwritten up front. I want every stone unturned. So this thing
Yeah.
sails through as smooth as silk toward the end.
Absolutely. And the biggest goals there is, I mean, I'd say there's 3 main goals. I mean, one is a better experience for the client, right? Is say,
Absolutely.
well, let's do these things up front. Let's uncover anything we need and let's be very prepared. So then you can jump into the fun side, go look for homes, have fun, not
Exactly.
worry about that stressful, aspect coming up later. The other huge thing for me though is as the market continues to pick up, oftentimes it's competitive, right? And we think about, hey, listing agents and sellers know not all pre-approvals are created equal. They
Correct.
know a lot of loans go sideways. So as part of our ability to help our clients, help our agent partners, when we're presenting that offer, we want full confidence in our clients to be able to pass that through to the seller and the listing agents to know, hey, it's a great lender. They fully approved it through underwriting. So we know this loan's going to go very, very smooth. And I think that can be a huge extra factor in the ability to get that offer accepted.
Yes, for sure. And listing agents know, and who you work with matters. And when you provide that ABC, we'll just use ABC lender, right? It's a red flag. I mean, I list a lot of properties. That's my forte. And I'm like, who is this? Is this any good? And I'm making phone calls. So
Yeah.
it's not only the buyer's agent I'm looking at because I'll research them as well. It is
Yeah.
the lender and or the pre-approval and that who is actually providing this. And the
Absolutely.
industry on my end, like we know many of the good ones, many we don't know, and some are great and they we have no issues. But
Yep.
without having a good lender with a good with an amazing resume and a good track record and presenting that to the listing agent is so important because you could win in a multiple offer and we're bumping up into multiple offers right now. So it's very
Absolutely.
important. Yeah. Great. Okay. Can you provide any insights into the current state of the trends perhaps that are happening with interest
Yeah,
rates right now, and not even interest rates, with loans. Like, what are some of the hot topics? I know I've talked to
yeah,
some lenders that will give you a pre-approval, can close in a week and act like cash, and
yeah.
they dangle all these carrots to the buyer up front. What are the trends you're seeing in
Sure.
these loans right now?
Yeah, I mean, I think there's a few things. I mean, as we migrate into 2024 now, we're seeing things start to pick up competition rise, right? So, I mean, last year a big trend was, seller credits, temporary rate buy downs, and I think those are great if doable, but I kind of feel like the market's pretty quickly going to eat up, and that's going to be trickier to get to. So I think a big thing, Kelly, that Cindy, excuse me, we're working on is the ability to have more competitive offers. To your point, pre-underwriting every single file, closings in less than 2 weeks on a standard loan for us.
Yeah,
That's huge.
it's huge.
We have a lot of bridge loans or transition loans because I think, again, the last couple of years, folks were writing contingent offers. That's just unfortunately, I think that's going to be very difficult in 2024. And there's always exceptions, but in general, as it picks up. So, for example, we have a contingent buyer, and it's stressful to try to sell and buy at the same time. The alternative is, hey, what if I sell first, find temporary living, then I could be non-contingent? Well, that's just not fun. So that's where we brought out like a transition loan. Hey, we'll give you the ability to buy non-contingent if your current home's listed. So there's some unique ones there. And then kind of
What?
as you
That's
mentioned,
interesting. I love that.
yeah,
So tell me more about that. So if their home is
yeah,
listed, but they don't have a written contract, they're not
yep.
under contract.
So really for us, as we look at it, so as a standard in the industry, they would say, well, technically, Mr. Client, you want to buy this new home and you still own your current one. So we need to qualify you with both mortgage payments.
Right.
And unfortunately, most folks don't qualify. Makes sense, especially if we're stepping up. So we've, as directors, built one of our portfolio programs called the transition loan. Because to us, we look at it and say, okay, realistically, they're going to sell their house, or for whatever reason, very worst case, maybe they decide to rent it. But there's either rental income or the payment goes away. So the idea of hitting them for both mortgage payments and qualifying, quite honestly, is just not fair. It's not accurate, right? So we wanted to step out there and say there's so many great clients that just need help in this transition. They qualify perfectly for the new house once theirs is sold or once theirs is rented, but it's hard to do either of those if I'm still living there potentially. And the idea of needing to sell first, find temporary living, turns off a lot of clients or is just way too complicated for the family dynamic. So that's been a really fun way. And I think, again, there's probably a lot of clients that think, well, I'd like to buy, but it's just too hard to buy. And there's no way I would qualify unless I sold. And that's not the case. This transition loan fixes that for folks.
Love that. And so what is there? So I know with a typical bridge loan, you're basically, and I
Yeah.
talk to people about this all the time, you're basically two appraisals, two loans,
Sure.
double trouble, really expensive.
Yeah.
It doesn't compute. But with a
Yeah.
transition loan, what does that look like?
Yeah, so we've really worked hard to streamline it. So, like for example, on a transition loan, we would have an appraisal in the new house, which is standard. But on the current home, for example, if you're listing it, Cindy, you've already done the comps, you've already prepared a CMA. We just would use that. Like the value's there, we know where it is, so we would use that to streamline it. And then as far as extra cost for us, I think a lot of times there's groups out there that are a specialty lender that just do bridge loans or just do maybe a transition. And I don't think there's a lot of them, but
Mhm.
that's their only income stream. So, I can appreciate, hey, they got to have X, Y, and Z fees. For us, we've built out the transition and bridge as a tool for our clients and agents to get to the new home. We're already going to help you with the new home mortgage. That's perfectly fine. That's our operational income. So
Mhm.
therefore, we've really worked hard to streamline any type of transition or bridge loan fees very, very low, because that's not the idea to make a bunch of money. It's the idea is help that client get into the new house, which is our normal operational income. So I think that's a niche we have is, the package deal. It doesn't need to have double cost because we're fine just doing one loan. This is more of that tool to
That's
get the client
awesome. So there is
engaged.
a little bit more of a cost, but not the
For sure.
significance of a double. And it's hard to say the
Absolutely.
number because it depends on who the buyer or seller is and the
Yeah.
house. There's no quick answer without a consultation with you.
There's not with like to your point. I mean, and really when we go through the numbers, almost every client's looked at, hey, to give me the ability to write a non-contingent offer, I would either get a better price or just even be in the competition, right? Versus contingent. But also if I did sell first and I had to go live in a temporary rental or do something, there's a lot of costs associated with that too. So that's our thing is when we really dive into the numbers, almost every client's gone, okay, hey, these little bit of extra fees more than outweighs what I would pay or just a
Sure.
headache of trying to do it the
Yeah.
other way.
That's great. I love it. Love it. Love it. Are there any special first-time homebuyer loans out there? Any grants? What's happening
Yeah.
in that arena?
So there's a couple of them. I mean, so like, we do a lot of stuff, of course, in Washington State. So you have the Washington State Housing Finance Commission, and that loan's been around for a while, but essentially, I believe this year's income level is 180,000. So if our base income is 180K or below, we would qualify for it. And it doesn't have to be a first-time buyer, which is kind of cool too.
Oh,
But it's used for a lot of first-time buyers. But essentially, you could do a conventional mortgage or an FHA mortgage, and the state would lend you 4% towards your down payment. So that could cover the entire down payment for you. And when I say they lend it to you, it is a loan in this case, so you would pay it back, but it's zero interest, no payments, and it's paid at the time of refinance or sale. So it's a pretty cool way of saying, hey, I can essentially borrow my down payment for free from the state, have that help me get into a house, and down the road when I refi or sell, I will pay that back, but there's never any accrued interest.
that's awesome. Why did
So
I not
that's
know about this? That's fantastic.
that's a great one. Then there's another
Great.
program, that's called Genoa, a very similar idea. And on that one, the second, that lent money for down payment can be forgiven after 3 years based on some income
Okay.
particulars. So there's a couple of really good ways, and we've used it for clients that don't have a down payment ready, or
Mhm.
vice versa. Some folks go, hey, I have, 20 grand down payment, but when we find the house, a lot of first time homes need a little bit of love, right? So they go out, I can put it down, but I'd have no money to update it. So I go, guys, what if I did the zero down with the down payment assistance? Then you kept that 20K you had for down payment to go in and do X, Y, and Z updates.
Mhm.
So it's a fun tool for, a couple of different types of clients to help them out there.
Cool. I love it. Love it. Love it. What are oh, this is a good one. So what are the typical costs associated? So I'm going to buy a house. I'm a first time home buyer. I'm a move up buyer. I'm going to
Yeah.
have a loan cost. What is the actual cost of the loan on what is a buyer looking at cash out of pocket? What are the options and what is the loan cost? Just
Yeah.
a quick overview.
Yeah, so again, it's going to be somewhat dependent upon the actual client's scenario and the loan type. But in general, I think there's a few things to look at. So sometimes when clients look at closing cost, there's going to be loan fees, third-party fees, and then prepaids. So I'll kind of dive into those. So loan fees would be something directly from a lender. So like, for example, us or most, you may see something like an underwriting fee or a processing fee. Now those are pretty small. I'd say most lenders, the total of those two is, $1,500 or so. So there's some cost there, and that's the operational cost for the lender. The other part from a lending side is points. And this is something where a client has options. So for example, interest rates today, like when I pull a rate sheet, might start at 8.5 and go to 5.5. There's a massive spread there. But
Right.
and some of that depends again on your credit scores and details. But within that, I might say, hey, Cindy, you have the option to be at 7% with zero cost at all in points. Or you could buy a rate to 6.5%, but there's a fee, and that's called points. Or you could buy it to 6.0 and there's points. So there's a lot of options there. Now, we help to coach our clients on what makes sense or not. And really, buying the rate down can be great if we hold the loan long enough.
Right.
So quite honestly, in today's environment, I'm working on pretty small points because one, I want to have less cash for the client. But secondly, I really feel confident not too far into the future, whether it's 12 or 18 months, I think rates will be quite a bit lower and there'll be a great refi opportunity. So if a client spent a lot of money to buy the rate down and then simply refi, they're never going to reap that benefit. So
Right.
we help to coach our clients and talk through, but that would be that first bucket of fees. So it's pretty small on the lending side. The third-party fees would be basics of appraisal, title, escrow, threat reports, just all the kind of associated entities that are helping through the transaction. Now, again, this is going to range a little bit based on the loan size, but I would say that's going to be between the 3,000 to 4,000 range for the average client.
Right. Okay.
So those would be the actual fees. Then the only other part of closing cost is prepaids, and that's taxes as far as property taxes and home insurance. So there is money you need to come up with, but it's not a fee of the loan. It's just part of closing because any real estate's going to need home insurance and have property taxes. Now, again, that would vary somewhat upon what that property value is.
And it depends on when they're closing, and there may be the prepaid mortgage interest
Correct.
for X amount of days until your loan, your first
Absolutely.
payment. And it's always in arrears too. And that's one thing buyers are always surprised at. So when you pay
Yeah,
rent, say I'm going to rent this apartment or this house, you're paying it up front to the
correct.
entity, right?
Yep,
but as a mortgage, you're paying in arrears. So you're making
exactly.
first payment after you've been in the home for a month. And a lot of people don't even don't understand. We assume that they know that, but they don't know that.
Sure. No, it's different because renting is so different. And I always explain the idea is really we can't charge you interest until you've actually borrowed it for a full month, to your point.
Right.
So,
Yeah. Yeah. A little bit different. So that's pretty cool.
yeah,
Okay. So we talked about the bridge loan, we talked about the specialty loan programs, and typical costs associated with. Um, is there anything else? Like what, I guess the question as we wrap this up that
yeah,
I would have is what do you do different short of what you
sure.
talked about? What sets you apart from other mortgage lenders and why should how
Yeah,
competitive are you? And what if somebody came in and said, oh, I'm working with, because we get this all the time. Well, I've talked to my bank.
yeah,
I bank with B of A or US Bank or whoever, and they said I'm good. I like my banker. I'm comfortable. So why should I talk
yeah.
to your lender?
Absolutely. That's a great question. So I think a couple things. I mean, one, from like a service level, we're nights and weekends. We know how real estate works. It's
For
going
sure.
nonstop, right? And as the market moves fast, you need that help. So we genuinely want to have an amazing experience. And I think our team truly provides it. But from more of a financial perspective is I think it's very common in the industry, and I appreciate clients wanting a good deal. And I think the way most folks think of that is, hey, a lower rate equals a better deal. And I
I
don't
do.
think that's always the case. And I'll explain why. Now, we have awesome rates. We're super competitive. I'm not worried about it. But my number one focus is helping to be the best acquisition lender and to give you as a client and again, you as an agent partner, the best tools possible to negotiate. So, for example, we've had plenty of scenarios like I just helped a client where it was multiple offers. We won in the multiple offer. And not only did we win, we were 20,000 less than the other offer. And I think clients sometimes don't understand, like, why would the seller not take it? And it kind of goes to our previous conversation is, well, that other offer, they weren't confident of closing. Our offer,
Right.
they were absolutely confident. So that's my goal in saying, hey, in-house underwriting, pre-approved upfront with underwriting, closing super fast in 2 weeks, or doing our same as cash. We
Right.
do an earnest money protection program to where after the inspection, you can literally release 10,000 earnest money to the seller. If
Yeah.
anything happened on the appraisal or on the financing, or you lost a job and forfeited your earnest money, we reimburse you as directors.
Right.
So it's a really cool way to say, how can we give you these different tools to where you can actually write a different offer and put yourself in a much better position? So
Sure.
for example, when I look and say, hey, I want to help my client out is if I could save them 10 or 20 grand on the price, that's significantly more in savings than an eighth or a quarter% in interest rate. So
Right.
I want to have both, of course, but that's my number one focus is what we pay for a house or how much we save. That's where we save big dollars. Just like an investor might buy all cash. Why do they want to do it? Because they can get a better price. I want to get my clients as close to that mindset as possible with these tools. So I'd say that's the number one thing we offer to really help them save money and get that better deal.
Awesome. I love it. And the other thing I think people don't understand as well is if your lender doesn't perform, it's not the lender who's on the hook, unless, like you say, your benefits that you have. It's
Yeah,
the buyer. You haven't performed. That seller doesn't have to extend, and you just violated the terms of the contract. You could
for sure.
lose your earnest money. Like it's a
Yeah,
big deal. Who you work
yeah,
with as number one is the agent who can actually get you the deal and give you the best advice. There's so
yep,
much value. And number two, the lender.
absolutely. And
Actually making the right choice and getting through and having this go through so that
yeah,
it's so funny. I've been talking to a lot of my old clients lately and they're like, I'm still traumatized over things that happened years ago. I remember, and they're like, what are you talking about? And I'm like,
yeah,
so I've taken it
right.
on. It's pretty funny.
No, and I think as you mentioned there, Cindy, having a great team is key for me,
It is
right? That's
so
something we want to
important.
work hard is, hey, I want to be working really closely with my client, but really closely with their agent. And it's the three of us together that are saying, hey, what's the right strategy and approach to win this deal or win at the best price or make the smoothest transaction? And I think a lot of times as an industry, it's kind of three separate people. There's a little communication, but not nearly as much as there should be. So I love that opportunity to work really tight as a team and make a much better experience for everybody.
Okay, I love it. I love it, love it. And one thing I love about your process with your team is your communication style too, and keeping your clients up to date weekly with what's happening during that process.
Yeah,
It's so critically important because there's so many moving parts. It's so
yeah,
nice and reassuring for them to know that it's handled. I mean, it's huge. It's such a peace of mind.
absolutely,
It's one of the most stressful things people go through is buying a home. So having a great team on your side is critical. So with that, it's amazing. So yeah.
absolutely.
Fabulous. Well, Brett, thank
Well,
you so much. I seriously appreciate your time today. And yeah, hopefully we'll have a great deal we're working on here soon. And if you guys have any questions about for Brett, I'll have his information available for you or for myself. So we're happy to help in any way we can. And we look forward to serving you soon. So thanks again,
Awesome.
Brett. Really appreciate it.
Cindy, I really appreciate the time. Thank you.
Absolutely. Okay, take care.